Okay, so let's come back. We're gonna dive into this some more. I want to finish up this. Let's finish up a couple more things on here. Okay, so what we've been talking about here is just kind of the different things. So by far, the trades that we do the most are these. All right. Generally, selling a put credit spread, to me, I love selling put credit spreads, especially because most of the time the markets kind of tend to either be choppy or up. So selling a put credit spread takes advantage of that. And remember, with the put credit spread, same thing. You know, this is what we're looking at is the stock can do 4 things out of 5 and we can make money. Okay. The same thing though is true with a call credit spread. Okay. Also known as the bear call spread, which again I hate that name almost as much as the bull put spread. If you sell a call credit spread, you think that the stock is just going to go down. So say Apple's at $700 and you think it's going to go lower. So you sell the 705 call. Okay, you sell the 705 call, you buy the 710 as protection, and guess what? Apple's either going to drop down to, you know, like 690, or it's going to kind of go down a little bit to 695. Or it's going to keep trading sideways at 700, or it may rally a little bit to 705, or it may rally a lot and go, you know, 710 and beyond. Again, here you have max profit, max profit, max profit, max profit, and here is where you're in danger of a loss. So call credit spread is just the same thing. You're just looking for the stock to ideally go down so then you don't have to sweat it. But if it trades sideways or even goes slightly up, you can still make max profit. Okay, so selling the put credit spread and selling the call credit spread is the core staple of our trading. Okay, the opposite of that is the debit spreads, which I'm not a fan of, to be honest. And I don't have a good reason to be a fan of it. I think for the most part, what I don't like is that if I think Apple's going to go higher, and I do a debit spread. And then I just see, you know, let's say you buy the $700 call and you sell the 705 and Apple does go to like $730. I think mentally I just don't like to see that the one that I sold is down like 10 grand, okay? Obviously I'm up because the one that I bought is up 15 grand. I think mentally I just don't like to see that. So that may be my issue with it. You know, honestly, I don't know because really risk-reward wise there's actually not much difference between a call and a debit spread. I also like the idea, though, on a credit spread. So on a credit spread, what happens is if it goes your way, just both sides go to 0, okay, and that's you're collecting the credit. And I think on the credit, what I like is that essentially you're paid on a credit. The cash goes into your account. So it's kind of like a credit spread is kind of like this. It's like someone comes to your house and says, hey, you know, I really need your hose, okay? I know it cost you $50, but I'm willing to give you $300 for it because I need it right now. And if I don't bring it back to you by the end of the day, you can keep the $300. It's like, okay, so you got that $300 in your hand. Okay, it's in your hand, and then at the end of the day, they don't bring it up. You get to keep it, and then you can go use 50 of that to go buy, you know, another hose. So the idea with a credit spread I like because you're receiving the cash up front, and it goes to 0. You don't have to sit there and watch some huge monster thing going against you like this, where again it doesn't matter because you know you're making it up over here. And I think that's part of it. So I like selling credit spreads a lot better than buying debit spreads, and there's not really a good reason one way or the other. I'm just kind of telling you what my process is and what I'm thinking of. Okay. Yeah, and actually I think credit spreads do have an advantage because you do have the little bit of theta decay issue when you're buying debit spreads. But there are times when you can buy debit spreads. But I just found that most times if you can buy a debit spread, you can sell a credit spread, and selling the credit spread works better. So when you buy a put or buy a call, what is that called? Oh, that's just okay. So that's just being long an option. So if you're buying a call, it's just buying a call. Like I want to buy a call on Apple. That's just buying a call. Yeah, there's no fancy name for it. All right, now the last 2 things that I like to do here. Okay, so we've covered these, and we're going to go, and I'm going to go into these in a little bit more detail. But so a new thing that we did also is a butterfly. And I'm going to talk about whether you're buying or selling those. But what you want to do is with the butterfly, because we're going to start doing these more too, is that for Apple, for example, on Friday, we were looking for Apple to pin at $700. And what I was attracted by the butterfly is at the $700 strike, the calls and puts were selling for like $5 each. So what we did is we initiated the butterfly, and that's what happens is you sell the $700, you sell the $700 call, all right, and you say you do 2 of them, and then you just buy one 705 and one 695 call, and then that kind of protects you on the outside. And the risk-reward thing on this is amazing because you're only risking like a lot of times, $1,000. You can set these up as like a 1-to-3 risk-reward ratio, risk 1 to make 3 or risk 1 to make 5. Okay. The trick is it's got to close right at the strike to get that max profit. So we'll cover that in a second. It's a little bit, and essentially what you can see is that what you're doing is just combining a put credit spread and a call credit spread at the same strike. Okay, so pretty much all spreads are a rendition of call credit spreads, of credit spreads. Iron Condors, all an Iron Condor is that you're selling a put credit spread and then you're selling a call credit spread, and guess what that's called? That's called an Iron Condor. So if you understand put credit spreads and call credit spreads, you'll understand about everything else. All right. So let's look at a couple of mechanics here on this, on the Thinkorswim platform. What you're looking at here is that for the most part, when we are doing something, what you want to come down here is just you're going to do sell vertical. Okay. 8 times out of 10, if you go sell vertical, you're fine, and that's when we're either selling a put credit spread or selling a call credit spread. Okay. You're just going to go sell vertical, and that's it. And this is how, and a really very handy feature on the platform, and you can see here is, and what's nice is you can look at it and say, okay, yeah, I want to sell the $700 put, and I'm going to buy the $695 as protection. That's going to give me a $2 credit on 10 contracts. So then that'll also tell you what your max profit is on the trade. So my max profit is $2,000, and my max loss is $3,000. Okay. And again, you can place a stop on this. So if you sell it for $2, then you want it to go to 0. Okay. If it goes to $5, that's your max loss because you got to buy that back at $5, and you will have, you'll have to cover the difference there, that $3 difference. But you could also place a stop loss at, like, say, $3.50, and then you could set it up where you're risking, $1.50 to make $2. So you can do that as well. And the different schools of thought there. You can either trade smaller and have your max loss equal to how much you're willing to lose on your account, okay, for one trade, or have a bigger spread and just place a stop. And we'll talk about the when of when to do these as well, okay? All right, so we're going to do a few more slides here on these basic mechanics. Now, if you want to buy a debit spread, you're going to do the same thing, buy vertical, okay? And this is, vertical is your friend here. You'll hardly ever see me do diagonal, calendar, not very much here either, never this, sometimes a butterfly, but really you can do everything you want here with vertical. Even when I do Iron Condors, I typically just do it as verticals. I'll sell a vertical call spread, then sell a vertical, put spread. All right, and same thing here. You can see on the debit spread, risk-reward ratio, and you can set it up. You can see it. I mean, it's a pretty reasonable risk-reward ratio. Max profit here was 3,000. In this case, max loss 2,000. Okay, so the risk-reward ratio on both of them is similar. Now, where things get interesting is what about Iron Condors? Because what happens is, you can sell an Iron Condor or you can buy an Iron Condor. What is the difference? Well, if you look at what we're really trying to do here with an Iron Condor, all right, is we're looking to just sell, right, a put credit spread and then a call credit spread. And we're going to look at some charts and talk about why. I just want to cover the mechanics of how this works. And you can see here if you're selling it, okay, or you're buying it, you're still getting, here's a $3.95 credit. It's just that if you're buying it, it's more of a debit. And then if you look at how this is constructed, remember what we're looking to do is sell premium. So here, we're selling the 705 call and then buying the 710 as protection. and then on the downside, we're selling the 705 put and then buying the 695 as protection, okay? Pretty much, I can guarantee you this, is that you will never see me buy an iron condor, okay? So when you're trying to figure out, gosh, do I buy the iron condor or I sell it? You sell it. I actually can't think of a situation where I would want to buy an iron condor. Maybe there will be one, but I never do this, okay? So iron condor, all I want to do is just sell it. And we'll talk about the objective of this in a second. And then it's always good to check the parameters too. And you can see here, like if I were going to buy that iron condor, suddenly my max profit is $1,000, but my max loss is $3,900. If I'm selling it, my max profit is $3,900. My max loss is $1,000. But you can always check the parameters on that. And then I wanted to check on the butterfly because there was actually a lot of confusion on this butterfly when we did this in the room on, I think it was Wednesday or Thursday when I set it up. And again, you have that same choice. Do you sell the butterfly or do you buy the butterfly? And if you don't know, guess what? Just try it. And just remember that when we're doing a butterfly, what we want to do is we want to sell the at-the-money strike that we're trying to do. And if you look at, if you sold this butterfly, what happens is it actually is buying the at-the-money strike, okay, and then selling the wings. And again, I can't imagine any time ever that I'd want to do that. Buying a butterfly, though, is you're selling, you know, you end up selling the mid-strike and then you're buying protection. Okay, buying the butterfly is a credit spread. And again, I'm really just more focused on credit spread. So you can do these butterflies, these iron condors, you can construct them as multi-leg debit spreads or multi-leg credit spreads. I am almost always, let's call it 9 times out of 10, doing credit spreads. Okay? And again, if you aren't sure on a butterfly, an easy way to do it is to look at the risk-reward ratio parameters here. If you're buying a butterfly, you can say, all right, my max profit is $4,500, my max loss is $450. That's awesome risk-reward. What if I was selling a butterfly? Okay, my max profit is $450 and my max loss is $4,550. You know, you're risking 10 to make 1. That's insane. So a lot of times it'll help just to look at the parameters. But what I'm going to do is you guys will have copies of these slides, so that way you can, for those of you that are newer, you can kind of take a look at these and then understand how to do that. So yeah, so what we did on Apple, everybody that followed this trade, we actually, we all made a lot of money on Apple on Friday because what we did is we bought a butterfly. Okay, so we're always going to be buying butterflies. So we bought the butterfly on Apple, and the way it was constructed up is, we sold 20 of the $700 strikes, and then we bought the wings on both sides as protection. And I did the call side and the put side. Okay, so I just want to put this together, and that's the end of that. Because I know that there was a lot of questions on that, especially for those of you that are more kind of beginner to even intermediate. Those are slides that we will share and upload for you. Okay. All right, so now let's do this. Let me bring up the paint. So yeah, so let's explain the butterfly trade. And let me bring and butterflies, honestly, don't do them very much. But what happened here, and unfortunately, it's not going to show here right now, so I'm going to have to recreate. But what happened is that at the $700 strike, which already expired, so these are next week's. But at the $700 strike, we had like 39,000 open interest on the call side. And then it was actually pretty high on the put side too, maybe like 13,000 or something like that. But combined, the open interest at the $700 strike was higher than any other strike. Okay, and so what happens is that when you see something like that, is there's a phenomenon called pinning, where the stock tends to get pushed in both directions towards that strike price that has the highest open interest. Okay. And the reason for that is actually fairly simple. It's because all the institutions and the hedge funds guess what? They're the ones that sell all those strike prices naked, okay? And it's in their vested interest, and they sell both the calls and the puts, and they'll sell them to, the retail public. So, on Tuesday they may have been selling those for $5 and $6 and $7. It's in their best interest to ensure that Apple closes at or very close to $700, so that those options that they sold expire worthless. Okay, and then that way, if they sold them for $7, they can buy them back at 10 cents. They can make a lot of money that way, and it's worth it for them to manipulate a stock, especially on expiration month, back into that pin level. And if if you're running a $20 billion fund, why not manipulate the market for a couple of hours and make as much money as you can? Okay, that's just the way the world works. The good news is that we have this information, we can see what's going on, and we can participate in it. And this is why I love trading the Thursday and Friday of especially monthly expiration, and especially this last month because that was the quarterly expiration. But every week, okay, every week this is available to do. Now, so what we did on this is that we were looking for it to get pinned at that $700 level, and when we were looking at this, and you can see right now we're at $700, right? That's where we closed. Well, guess what? The $700 calls are $9, okay, and the $700 puts are pretty much the same thing, and that's all pure 100% honest-to-goodness premium. And if Apple closes at $700 next Friday, guess what? This is going to be 0, and this is going to be 0. I mean, we may get pinned at $700 again next week. So this would be a good example of doing the butterfly, where we sell those $700 calls and puts, okay, and then we buy. So we sell those, and then we can buy these as protection on both sides. And the reason for doing this, the way the risk-reward ratio of a butterfly looks so good. But the reason it looks so good is that it has to close right at 700. If it doesn't close right at 700, then you're not going to get your max profit. Okay, so butterfly, I'm actually not a huge fan of, but I will do it on options expiration when you have a large open interest. So this butterfly that we did on Wednesday in the live trading room, we set it up, and it looked like this, and I'll just show you what it looked like. So this is how I did it. I did it on the call side and the put side. So I had -20. Let me get a darker color so you guys can see that. All right, so I sold the calls, okay, and I sold the puts. Okay, and that's the $700 strike. Now, the best thing to do would have been to just leave them naked, right? Like, wow, they're naked, and they're going to go to 0, and I'll collect all that money. But of course, you got a lot of risk there. What if Apple takes off, and then plus the margin requirements are super high for that. So then what you do is that, you go on the wings of this. So on the call side, you're looking at 695, 710, and then on the put side, essentially doing the same thing. Or sorry, that's 705. 705, and then you're just buying those. And all this is, if you guys are seeing what this is, these are all just credit spreads. So I mean, that looks very complicated, right? So this is one butterfly. Okay, and this is the other butterfly that we did. And it looks pretty complicated. And the way this was set up is that max risk was $1,200, and then max profit was $3,700. And it's the same thing here. Max risk $1,200, max profit $3,700. And of course, we went to $700, and we got max profit on both of these. I mean, it was a killer trade, and it was very, it was very smooth. And a good question: why do calls and puts? It doesn't really matter, to be honest. You can just pick one or the other. I kind of did both just to show. In fact, let me do this real quick. I took screenshots of these as well, and this will kind of help. But all this is now, I just looked, and the first time I saw a butterfly, I'm like, oh my God, that's so complicated. But guess what? All this is credit spreads, right? So you did here, I mean, if you think of it over here, you sold the 700 calls, bought the 695s, okay, and then you sold the $700 calls and bought the 705s. So credit spread, et cetera, okay? So we did this on Wednesday. It expired Friday, so we held it for 2 days. Now, I've got some screenshots. Let me bring these up of what it looked like as, and the nice thing about this too, because if you understand the butterflies, that'll help with some of the other stuff here we're getting ready to talk about. And PowerPoint, images. All right, so let me see if I can blow this up a little bit, because that's worthless. All right, hold on. Let me just insert these into I'm going to insert these into the PowerPoint so you guys can have them as a reference. Okay. And you guys can have this PowerPoint too. Okay. That's not that good either. All right, so the resolution on this is not that great, but you guys will have a copy of this. But I will let me just copy these real quick, and then I'll show you. I'll just write it out what it was, but then you guys will actually have a copy of this as well. I just wanted to show you how that butterfly progressed over during the time that we were in it. And then this is the last one. And you guys can get an idea of the nice thing I like about the butterfly is that the fluctuations are very easy to deal with. Like directional trades, you really got to deal with a lot of like fluctuations and things like that. So all right, there's got to be a way I can blow this up a little bit. Let me try. All right, just up a little bit. So I'll write out these numbers, and then you'll be able to see them. But so this was the trade that we did. Now, here's the call side, okay, here. And then here's the put side. And what you can see here is when I established, so I established this on Wednesday, okay, when Apple was at $702. Okay, so that's when it was established. This screenshot is on Thursday morning, and Apple is at $697, okay, and it's down like $4. Now, this is a lot of contracts. This is 80 contracts, 40 on both, right? And if you look over here at the open P&L, my open P&L is plus $179. So one of the nice things about the butterfly is that the stock, underlying stock, can have these crazy moves prior to expiration, and your P&L is going to benefit from theta decay. All right, so I was like, wow, it's down $5. My butterfly is probably going to hurt. I was like, oh, it's actually not that big a deal. On the put side, I was up $124, and on the call side, I was up $55. Okay, so really it wasn't a big deal, and that was with Apple down $4. Okay, and now if we go to the next slide, okay, and we can see on here, this is that same day, and Apple's been still down on the day. Okay, and this is Thursday. This is like 2 days ago, and Apple's still down on the day. It's At this point, Apple was still down like $3 on the day. But now you can see that we're open. The put side has gained up to $344, and the call side $385. So now we got P&L $729, and this is all from premium decay. All right, so things are kind of going along well. Again, what we want to see is it closes at 700. All right, so now here we are on Friday. Okay, and guess what happened on Friday? Apple gaps up, and it's up $5. Okay. Apple is trading at $704. It's a huge gap up, and what does our P&L look like? Well, it's only dropped like $100. So yesterday at the close, we were up plus $700 or plus $795, and today with this huge $5 gap up, okay, you can see the P&L is $649. So we've only lost about, well, let's call it $160. So here we have this huge move in the underlying stock where if we would have had puts, would have been destroyed, but the butterfly actually, everything kind of offsets each other. All the, you've got the puts that gain value and the calls that gain value, et cetera, and all the while the premium is decaying, okay? And remember, our goal is that it gets close to $700, all right? Okay, so now here we are getting close to the close. This is about I want to say 1 p.m. Friday, right around there. And Apple at this point is at $700.73. And now look at the P&L jump. Because now what's happening is we are capturing all of that premium decay from the $700 levels. Okay, remember we sold these, they were like at $7, and now they're only at $1.50. We're capturing all of that. So you can see that, here we're up $7,000 on what we captured. Of course, we're losing money on the ones that we bought, that's our insurance. But now, the put side is up $1,900 and the call side is up $1,800. Now we have open profits of $3,800. Eventually, we saw that Apple pinned right at $700 on Friday, and this became max profit, which was $3,700 per side, which was $7,400. Okay, so we had pretty much no headache. Okay, no pain, and the stock was actually up or down 10 points. But remember, what we needed is we needed it to close very close to $700 to get that max profit. And because we had the advantage of understanding the open interest and how that open interest impacts the price of the stock, we were able to take advantage of this trade. Okay. So one question is, how did you choose a pin at 700 when placing the trade? Okay, so Paul, that was the open interest. Okay, that's how we did that. But then why both calls and puts? You actually don't need to do both calls and puts. I did it just because I could have just done chosen one side or the other. I like to do it just to see kind of both sides. Okay, so now a good question. What if it had not pinned? Well, if it hadn't pinned, what I liked about this trade is on both sides, on both legs, the max loss was $1,300 and the max profit was $3,700. Okay, and that was on both sides. So we'll do calls up here and puts down here, and this is give or take. So you actually had an attractive risk-reward ratio, and the closer that you are to $700, the more money you're going to make. Okay, so essentially at $700, you've got your max profit. Okay. If we closed it like 701, you actually would still make a lot of money. At 699, you still make a lot of money. But the further, essentially, you get away from $700, the more you're gearing towards the max loss on that trade. Okay? You don't have to close right at $700, but it's just essentially the more you creep away from it, then the more risk that you have. Okay?